Can I back up just a little bit? Because I wanted to clarify one other thing that I think for some reason it's a mental hurdle. At least I don't know, Rob, maybe you're the same way and maybe not. I don't know. But
no, I'm a genius. I got it all. So good. No, but go ahead.
Okay, good.
Welcome to the Fiscal Foxhole, the podcast proving you don't need a degree in finance, just some grit, a game plan, and maybe a sense of humor. Your hosts are retired Army veteran Rob Moore and retired Marine veteran Omen. Together, they'll help you dodge financial landmines, call in the air support on your savings, and laugh at the ridiculous money mistakes we've all made. If you can survive mandatory fund days, you can survive personal finance. Welcome to the Foxhole.
And welcome back to the Fiscal Foxhole. I am your host for today, Rob Moore, and joined, as always, with my ever so professional and knowledgeable colleague, Omen.
What's going on, Rob? I thought you were on Firewatch, not hosting the show.
No, actually, so while you were asleep, I paid the dudes in the next foxhole to come cover our Firewatch for us. So yeah, I was very snug. I'm well rested. I'm not going to fall for it again when you put me on Firewatch early and then you have to wake me up early for this nonsense.
No, that does not surprise me.
Speaking of work, I was going over the last episode, listening to it. There was an interesting part about it, and I remember hearing it while we were recording. And I want to ask you, what do you call it? It's not a trick question, but I just want to hear you say the term. When money is taken out of your paycheck to pay estimated taxes or taxes ahead of time, what is that term called?
Like where this is going, Rob.
But what's the term?
Hang on. I mean, it's just a withholding.
Correct. Right. Withholding. When we were recording it, I'm like, am I crazy? He keeps saying withholdings. Like, so you're calling it withholdings. And I'm like, am I crazy? Like, I've only heard.
Of course you're crazy.
Am I crazy about this? Maybe it's the question. Because I'd never heard it plural. And then when I was editing and listening back, I'm like, yeah, you use it. And I think you use withholdings when you're talking about like if it's multiple W-2s or maybe it's both spouses have their separate with. But I had never heard it as a plural term. So I always thought like withholding, no matter what, let's just say if it's one family or one person, everything that's kind of withheld along the year is all withholding as one thing. It's like the plural of withholding is withholding.
See how this is, Rob. This is where we're going to dig in, isn't it? My grasping of the English language at this moment. This is where we're going to dig in. Okay.
Let's just thank God it's not called FAFSA and just called withholding, because then we'd have a real problem, right?
We'd have a super real problem. Hey, you know what? While we're doing this to each other, I wanted to bring something forward out of our off-duty section, because
bring it.
If you're not familiar with our off-duty section, go back and listen to some of the other episodes, and all of the other episodes actually, and you'll notice that there's a lot of extra time on the back end of each episode, and you probably don't know why. If you just let it go for a couple more seconds, you'll figure it out. But in our last recording, I mentioned something about the fact that while I do enjoy what we do as podcasters, going through the draft version at 1.0 speed is driving me absolutely mad, because that's not what I usually do. My podcast is set at 1.3. You revealed to me in that last off duty that you are psycho, and you listen to everything at 1.0. And it really, I mean, honestly, I'm starting to question my life choices by doing a podcast with you at this point. But 1.0, come on, man.
This reminds me, do you know the Saturday Night Live skit with Ryan Gosling when he obsesses over the fact that the Avatar font, the font that James Cameron uses in Avatar, is just papyrus. It's just the font papyrus that he just chose that. And he obsesses about it. Like he can't live his life. He's not eating. He's not sleeping. Like he's distracted from life and detached from his wife because he's obsessed with that. I imagine that's probably what's going on. Like Megan, you're at the dinner table with Megan and you're not eating because Rob listens to podcasts at 1.0.
I don't think that I really obsess over the fact that you listen at 1.0. I just can't comprehend how anybody listens to a podcast at 1.0. And personally, I do think our podcast sounds better, at least 1.2.
Well, I hope it does keep you up at night, because if it does, then we would have good use for this episode, the second episode of our 3-part series on tax planning. We're back at it again. If you enjoyed the last one and all the numbers and ideas, and especially the tax planning. What was it? The tax formula that we went over in detail. We did a pretty good job boiling that down, I think, but still, if you got through that, congratulations. I think this one's a little bit easier to understand because today we're not talking about all that, I guess, really kind of functional knowledge about the income tax withholding. We're talking about something that is a little lesser known. It's called tax loss harvesting and tax gain harvesting. So if you have a brokerage account, buckle in because there's some real advantages, whether the market's up or down. If you have taxable brokerage account, there's some advantages here for you, and we're going to get into it.
We are moving away from, like you said, the fundamentals of taxes and getting into more, I would call it tax strategy, right? Something that makes it a little bit easier to listen along.
And just like the last episode when we talked about certain types of tax things you have to do before the end of the year, this falls in there. So you need to execute these things before January 1st. This is more interesting, I think, than our last one. But just to reward you for being along the ride today, I did add in more tax facts. So you'll have a little bit of a respite here and there to kind of clear the cobwebs. And before we jump back into the nerdery.
I'm sure that's why everybody actually listens to the episode, is just for your tax facts, Rob.
My tax facts. Yes. Yeah. Whatever works to keep people coming back, I'll do whatever. I'll do whatever it takes. I will read whatever's on the teleprompter. I will read it. So whatever you put on there, I will do. So
I have a feeling we're about to get a few more emails.
Yeah. Good. I read the script. I don't know if you have any grenades in there for me, but we'll find out. Well, hey, let's before we get into all that fun tax stuff, we've got a headline to take care of. Today's headline comes to us Kiplinger. Again, Kiplinger, we keep going back to them. It's always good stuff. I think I sent you another article from Kiplinger a couple days ago. Good things coming from them. But this one's from Rachel Green, who writes an article entitled, "Is Your Car Model Driving Up Your Insurance Premium?" Just diving right in, she says, if you're in the market to buy a car, you might want to double check the make and model you're considering before signing the paperwork. If you don't, your car insurance premium could suffer. I think what she's alluding to here is the fact that insurance isn't, one size fits all. People think about your driving record or maybe good student and other individual things like that, but the actual make and model of the car make a huge difference with your tax insurance premiums.
A few years ago, and they might still be going through this, but I think it was it Hyundai or one of the cars was really easy to steal. Really easy to steal. I can't remember what it was, which model it was. I'd have to look that up. But it wasn't all that long ago. And just the fact that they were so easy to steal, the insurance rates on those particular vehicles went straight through the roof. So if you owned what you considered to be a rather inexpensive vehicle, suddenly you're paying way more for your insurance premiums.
Well, unless you're running with apparently car thief gangs like Omen, you might not be aware of that. But yeah, that's another thing. Yeah, go ahead.
Rob, I mean, to your point though, like those are things that are out of your control, right? You can control whether or not you speed and get speeding tickets or whatever else, but you can't control the fact that your vehicle suddenly becomes a popular vehicle to steal. You can't control that. So you only have a couple of options. You either sell it or you pay the premiums one way or another.
In this point that we're talking, the reason why we're bringing this up is because it's a little timely. Car insurance rates have, just like everything else, has increased in cost recently. Rachel notes the average car insurance rates have been rising across the board, according to Bankrate. The cost of car insurance is up nearly 12% in 2025 alone, averaging $2,671 per year for full coverage or $806 per year for minimum coverage as of October. But some makes and models are more expensive to insure than others, like you just said. So insurance rates are going up, and it varies on what car you decide to buy. So let's break this down a little bit. First of all, let's just talk about insurance in general, because I think we should always return to the basics, the fundamentals of all these concepts. I mean, what is insurance at its heart?
Purpose of insurance is to offload risk. At the end of the day, that is what you are purchasing a policy for. Is you want somebody else to take on the risk of something bad happening, in this case, to your car, hurting somebody else's property. If you have a significant accident, there's a chance that you could completely wipe out your financial plan. And it's the reason why anybody would buy any kind of insurance. If you buy life insurance, it's because maybe that's the breadwinner and that's where all the income comes from. And so you need life insurance to cover in case that income goes away for the next, however many years. If you buy healthcare insurance, you want the insurance company to pay for your healthcare bills because you know that if you have a significant event, if you have cancer, your healthcare bills are just going to go through the roof and completely ruin your financial plan. So insurance at the end of the day, at its core, is to offload the risk that would ruin your own financial plan.
Included in those risks that we're offloading for car insurance are main points like property damage to your car, other people's car, like you said, either people or the things hit by the car, medical coverage. And then the big one that I think you're alluding to that's going to ruin your financial plan is liability. We're going to dive into that in a bit. But those are kind of the main concepts of auto insurance. There are state minimums that every state requires. I believe most every state requires at least a minimum amount of coverage for your auto insurance. But that's where you should begin looking at what type of coverage you need, because it depends on you. Just remember, the state minimum is there to have a low kind of bar, a low kind of hurdle to get over to make sure you're insured in some way. But to Omen, to your point, you might want to choose to offload higher levels of risk onto an insurance and paying, higher premiums for that offload. Because if you choose not to do that, not to offload that risk, the insurance company, the risk is still there. You just remember, instead of offloading it to the insurance company, you're just choosing to adopt it yourself. You're going to carry that risk and pay the price should something happen.
Rob, we're talking to a bunch of military members who do ORM sheets on a weekend basis. They do a 72 or 96 and they're doing risk assessments for their travel plans. So certainly the military audience would understand that they need to do a risk analysis against their own life to look at how likely is it that I have a significant event occur to me. And if that event actually occurs, then how damaging is that event going to be to my own life? And that's really the way that you should look at whether or not you need insurance. I want to inject here real quick. If you have teenage drivers, wow, get insurance, get the maximum that you have, because your liability for this, they're learning to drive. And my boys, they learned to drive in Virginia on Interstate 95. Like, that is scary.
Mad Max.
And so, oh my word. So if you don't have some kind of liability coverage that would prevent you from being sued, because you can be sued if your son or daughter causes an accident. In fact, I'd assume that it's fairly common, actually.
I actually have a different warning related to teenage drivers, which I'll get to here at the end. But yeah, you're right. You just make sure that the coverage is the risk that you're willing to take. With a child, young adult driver, I should say, the risks are higher. And so you probably need to look at that coverage, because you can, change the coverage for their vehicle, right? You can, even if it's the same vehicle you've had and given it to your kid, you can change the coverage on that and up it, make those coverages higher, paying a higher premium, but with the understanding that you're going to be covered more, should something happen.
I thought it would be a little bit helpful also to break down those numbers that people see on their policies real quick. So,
Sure.
So when you look at your insurance policy, you're going to see a couple of different numbers on there. It might actually be spelled out for you. Sometimes it's not. Sometimes you'll see it listed as like 100, 300, 100. It's usually three numbers in a row. And those numbers mean something. The first number means it's the amount of coverage that you are given, or that you're purchasing really, for bodily injury per person per accident. The second number is the amount of bodily injury in total. So if you injure multiple people, then this is the max coverage that your insurance is going to provide for you. And then the last number is going to be the property damage per accident. So let's back up, Rob, to your state minimums, right? So state minimums, I don't know what you've seen, but they're low. It's like 25, 50, 25 or something like that, right?
I don't know.
They could be low.
I don't know if I've seen that low. Let's do a quick look.
Okay, do a quick look while I talk through this a little bit. Depending on what your state minimums are, depending on how low they are, the cost of a vehicle, like costs of vehicles to replace them today, $40,000, $50,000, $60,000, $70,000. State minimums aren't necessarily going to cover that. And if it doesn't cover that, guess whose pocket that is coming out of? So medical bills, the property damage, like that is coming out of your pocket, the difference. What'd you find?
Yeah, I thought you're right. So I guess I just don't pay attention much to the state minimums anymore because, we kind of have the standard insurance policy that we've kind of always had and the coverages that we like and work for us. But yeah, you're right. Most of them are pretty low. The lowest is Florida, 10, 10, 10. Good
my
Lord.
gosh.
Yeah.
That would do nothing.
Although I know most states fall around 25, 50, 25. So well done. Yeah. Good research on that. I was unaware that they were so low, but that just reinforces the point that that's just that low standard that to get people to make sure they have some form of protection. So,
yeah, and I do want to, can I add one more point here too on those minimums and maximums? So a lot of people do that so that they can just have low premiums, right? There are different ways to get lower premiums. We can talk through that later, but the one thing that I do want to point out here is that if you get the max liability coverage here, then it matches nicely with an umbrella policy because when we talk about your net worth and protecting your net worth over time, we want the upper end of your auto and home liability policy to actually hit the bottom end of your umbrella policy. We want those to meet at 300,000 or 500,000. So we want you to get the most liability coverage that you can with auto and home.
Because that's the liability is when these accidents touch our lives, right? Because if you have an accident, you've got the car to deal with and God forbid an injury you have to deal with. But the liability is when, someone comes after you personally for whatever they perceived as the liability that you had in the accident. And then you're sued. And now you're open up yourself to like losing your home or other assets you've worked hard to gather. So that's pretty comprehensive what we just talked about, but let's get back to the heart of the article. They're talking about the different, types of cars. And you've actually you've broken down here the cheapest ones and the most expensive to insure. I'll start with the lowest ones. These are all surprised me because I was searching for our daughter. I thought it was like going to be small sedans that were the cheapest, but in fact it's these small SUVs end up being the cheapest to insure. So at the low end, for these is the lowest 5. They're all fall into that category. The small SUV, you got Toyota RAV4, Toyota Tacoma, Jeep Wrangler, Honda CR-V, and Subaru Outback.
I was happy to see both so I have a Tacoma now and I had an Outback before. I was happy to see both of them on the list. Yeah, that's awesome.
Yeah, you're good at
this. I didn't even do the research.
Yeah.
I didn't even know.
And moving on to the most expensive. So these aren't hard to, these aren't easy to steal, I don't think. But these are probably maybe more expensive to repair because on the top 5, Lexus RCF, Dodge Charger, Tesla Model S, Plaid, Tesla Model X, and the Audi RS Quattro Performance. So there's also some performance cars on this that might imply that the drivers may be more tempted to, I don't know, drive those cars faster. If it's a performance sports car type of thing, maybe the insurance companies see them as getting in more accidents.
So let's wrap up this news section here real quick. I think I can do this in basically one sentence. Make sure you tailor your insurance to your specific needs and get the coverage you need, not the cheapest coverage.
I feel bad. I'm going to have to add one more thing after you summed it up so beautifully. But just to your point, like to make sure it's to you. Case in point, we just added our daughter as a driver and a car. So now we have 3 drivers, 3 cars. Looking at our coverage, I noted that we still had rental car coverage if we had a car in the shop. And that worked out great because my wife and I were both commuting and just had the 2 cars and everything. So now we're adding a 3rd car and a 3rd driver. And I'm not driving onto post anymore. So it's like, well, wait a minute. We don't need rental car coverage because, if something happens and we got a car in the shop, we still have 2 cars and 3 drivers. So we've gotten by so far without it. And also I'm not going to work. Yeah. So we didn't need it anymore. We dropped that luxury. So it's just a perfect example of like, just make sure you're tracking your own needs and what you need and make it apply to you.
I'd hate to have your premiums right now.
We switched. We had to. I don't want to disparage our insurance company because it's a good one and a lot of military folks use it. But for auto insurance with a new driver, it just did not work for us. So, but maybe that's for off duty. All right. Well, I think we dug into that pretty deep. But we do have some business to take care of with the main topic of the show with tax loss and gain harvesting. We're going to break into this topic. Okay, tax loss harvesting, tax gain harvesting. You're going to hear more about tax loss harvesting. That's the most popular side of this coin, but we're going to talk about both. Let's back up first. What are we talking about with harvesting? What exactly are we harvesting?
Yeah, it's we have got a bean field out back, and we're going out there in our boots early mornings. No,
I'm harvesting.
Okay.
I'm harvesting my giant dog's droppings in the yard every day. That's what I'm harvesting.
Beep.
Yeah,
we're gonna bleep that out. All right, big picture. We are being intentional with our investments. And so when we see investments that are losing, when we see investments that are gaining, we're going to be intentional about selling investments at a loss to offset gains from selling other investments. And we can do this. This is in this tax year type of strategy, right? Like Rob said, this is something that you want to do before December 31st, probably before December 31st, even like by a couple of weeks or so, as we mentioned on our last one. Yeah. But for an example, if you sell an investment ABC, and there is no ABC investment, but if you sell investment ABC at a $4,000 loss and you sell investment XYZ at a $5,000 gain, for the year, you only have a $1,000 gain. That $4,000 loss offset your $5,000 gain, and now you only have a $1,000 gain.
That's a great simple explanation. We're going to get more detailed into it and explain how that works, but that's at its heart, that's how it works. Let's back up even further. We talk about a loss and a gain. Some of our listeners might not be aware of what that exactly that means. I'm going to try to be simple with this. Let's use your ABC. You said sell investment ABC at a $4,000 loss. What did we lose? What that means is from what you paid initially for ABC, you're selling it for $4,000 less. So let's say you buy ABC for $10,000. I don't know how much the shares are worth, so I don't know how many shares it is, but let's just say you buy $10,000 worth of ABC. Disregarding all of the other adjustments that can happen to your cost basis, let's just keep it static. Let's just say that now you have $10,000 in cost basis for ABC. That goes forward indefinitely. And then let's say in 5 years, now the value of that same amount of shares is worth $6,000. So you have ABC with a cost basis of $10,000, but it's now worth $6,000. If you sell that year for $6,000, you've experienced a loss of $4,000. You do have to sell it though. That's the important thing. Before you sell it, it's called unrealized loss or unrealized gain if it's a gain. You haven't realized it yet. Only when you sell, then do we look at the basis and subtract from the gain if it's a gain. And we find that loss or gain.
That's a great explanation. I do know that people are confused about what basis is. And basis plays a large role in not only your investments in stocks, but also like in your home even, right? Like understanding how much you paid for something plus all of, in this case, maybe some reinvested dividends or some stock splits and things like that. Like all of this goes into your basis. And so I think if I were to give advice to anybody about basis, that is to track it.
Yeah.
Understand how much you paid for something and don't leave it up to the investment company that you invest with. If it's, Schwab, Fidelity, Vanguard, whatever, like, sure, they're going to keep their records, but I've heard many, many, many stories about people who just lost their old records. And the thing is when you lose that record, what does your basis turn into?
To the IRS?
Nothing.
Zero. Yeah, $0.
Zero.
Yeah.
And now everything's a gain, right? Or everything's a loss.
Before we get any more math, I do have a tax fun fact to kind of clear the cobwebs. While you think about that, cost basis, gain and loss, is our first tax fun fact of the episode. This is called the beard tax of 1990. I always say that. I did that last time. I said 16. It was 16 and I said 19. So, okay. Yeah, this is the beard tax of 1698, which I think you're going to be really interested in. I put this in for you, buddy. The story goes, Tsar Peter the Great of Russia wanted to modernize society by encouraging men to shave. His solution? a tax on beards. Anyone who wanted to keep facial hair had to pay and carry a token as proof, and the coin that they would carry around as a token even bore the inscription, quote, "The beard is a superfluous burden." Couldn't agree more.
Burden?
Yeah, what do you
I don't have to do anything.
What are you hiding over there under that beard?
I don't even have to do anything with the beard. Although I do shave it.
I was going to say, it looks pretty trimmed. It looks pretty clean.
That is
You take care of that. Yeah,
it's clean.
Yeah.
Yeah. So this would put me in a predicament. Mm-hmm. Megan told me, like, I can't lose the beard. I look at old pictures, and it wasn't that long ago I didn't have a beard, but I look at old pictures, and Megan said, never again. Like, you have to hold the beard. So pay the tax or death by whatever. Yeah, I don't know what I'd do.
It sounds like Megan's going to pay the tax.
Probably.
Yeah. Well, because you have to bear the burden, the superfluous burden, as Tsar Peter the Great said. All right.
Somebody's got to do it.
Back to business here. Okay, let's dive in, because it's not just as simple as a loss and gain and that's it, right? We're talking about offsetting them between gains and losses, because you could have a bunch of transactions throughout the year. Some of it could be short-term gain, short-term loss, long-term gain, long-term loss. Let's talk about those terms first. What's the difference between short-term and long-term when we're talking about gains and losses?
1 year and a day. That is the determining factor between short-term and long-term capital gains and losses. And really, for short-term, everything there counts towards your ordinary income rate. So 12, 22%, 24, higher, whatever it happens to be. If you sell something at a gain or at a loss, but really this is more so for a gain, you're going to get taxed at a higher rate than if you had waited for that 1 year and a day, where now you move into your long-term capital gains rates of 0, 15, or 20. That's it. And those brackets are wide, right? So 0%, let's just do this real quick. I hate doing this over audio, but let's just do for a single person in 2025. The 0% to 15% tax bracket is $48,350. So if your income is somewhere in there, you're getting taxed long-term at 0%. Between $48,350 and $533,400, that's 15 to 20. That's huge.
Yeah.
That is such a wide bracket. All right. So that's just to give you an indication. Most people find themselves in the 15%, which is usually, well, not usually, it is less than the ordinary income tax rate that they are paying.
Yeah, that's well said. So basically what you're saying is short-term gains are going to be taxed at your higher marginal tax rate. Long-term capital gains are taxed at that preferential rate that you just said, usually for most folks, 15%. That's a really great advantage to having a brokerage account and being able to time out when you want to sell assets at a gain. So we're talking about losses. The flip side also works in the same way. The short-term, losses can offset short-term gains, and long-term losses can offset long-term gains. And that's how the first step of this works. So let's say you had a bunch of short-term losses and short-term gains on the year, and you also had a bunch of long-term gains and long-term losses on the year. So you've sold a bunch of stock this year in different lots. And then you have some gains and losses, both short and long term. You don't report all four of them to the IRS as each individual thing, and take the deductions and whatever. They have this process where you start to match up the gains and losses and offset each. So let's start with the quarterfinals. I like to think of this as like a sports analogy, right? You have 4 teams, the final four. Yeah, you said the final four. So you have the short-term league and the long-term league. So the short-term gains and losses play each other, and the long-term gains and losses play each other. Okay. So if you have, let's say you had $5,000 short-term gains, $4,000 short-term loss, they play each other. The winner is the short-term gain. So now what you have left is $1,000 short-term gain. Okay. Now let's go over to the long-term teams playing each other. Long-term loss of $5,000 and a long-term gain of $4,000. The long-term loss wins. So you have a long-term loss of $1,000. So now you have the short-term gain and the long-term loss left over.
It's the final.
Now they play each other. Even though they're different types of gains, you're able to actually offset them. And since you have a long-term gain and a short-term loss, and they're both 1,000, it's a tie. It's a 0 No tax consequence for that year.
I love your Final Four analogy. we're not getting around to March Madness quite yet, but I do love this.
It's the only way I can remember it, because it doesn't make sense. Because if you're, like long-term gain, all of a sudden, it doesn't matter if it's a long-term gain or loss, and you're offsetting different types of taxable income. It's really strange, but the nice thing is you understand it. It's actually pretty simple and makes it easier.
I really can't add anything, and I'm not going to add anything to that.
One more thing to add on. I made a real neat example there, and they ended up putting a tie, so nothing. Let's say you had a short-term gain of 2,000, a long-term loss of 1,000, and you bring them together, the short-term gain wins, right? So now you have a gain of $1,000 to report. It does apply to short-term. So it's a short-term gain of 1,000 because the short-term was more. So that's how it applies on your taxes. Okay. So just be sure whatever the winner is, quote unquote, that's the type of gain or loss that you're reporting on your tax return.
Yeah. Great follow-up clarification there.
All right. So I got another tax fun fact here to break up the monotony of all these numbers. Tax fact number 2. This one's called the cat food deduction. This one's pretty straightforward. This is kind of interesting. I think most people will understand how this works, especially if you're a small business owner. But this is just a story. I don't have a year on it, but the story goes that a junkyard owner in the U.S. once successfully deducted the cost of cat food on his taxes. His reasoning was that the feral cats that he fed help keep snakes and rats away from his property, making them a legitimate business expense. And the IRS agreed, apparently.
Is the first useful thing I've heard about cats.
Yeah, I don't understand. So to protect the junk from rats? What's what are we worried about here? Yeah. Yeah. But yeah, it goes to the point. Remember we talked about the ABBA clothing, the clothing you apparently have in your closet?
Yeah. No.
Yeah. It's just another example of just as long as it's justifiably used solely for your business, you can write off lots of different things. Like I said, as long as the IRS, if they come poking around, it's like, what's up with this cat food expense? If you have a reasonable justification, you can show it. Then, the IRS, they have to prove you wrong or prove no, you're enjoying the company of these cats too. So you can't, it's stuff like that. Those are the conversations you would end up having to have. It's just that simple. This episode is brought to you by the Military Financial Advisors Association.
MFAA is a global network of independent, fee-only fiduciary financial advisors who specialize in serving military families.
And we're not just highlighting it. Omen and I are members ourselves, so we know firsthand what they stand for.
That's right. Every member of MFAA is either active duty, a veteran, or a military spouse, so they truly understand the unique financial challenges that come with military life.
Plus, every advisor must hold or be actively pursuing the CFP designation, which is the gold standard in financial planning.
Well, let's put that together. When you choose an advisor with MFAA, you are getting a professional who won't sell you a product, who knows the military life, and will plan using your hard-earned military benefits.
Whether you're navigating a step out of the military after 4 years, a military retirement, or a transition into a work-optional lifestyle, MFAA advisors speak your language.
Visit militaryfinancialadvisors.org to find an advisor who fits your mission.
MFAA, real advice, real experience.
This advertisement is for informational purposes only and does not constitute financial, legal, or tax advice. All investing involves risk, including the loss of principal. Information and opinions provided within the fiscal foxhole do not necessarily reflect official positions or opinions of the Military Financial Advisors Association or its members. Consult a qualified financial professional before making any financial decisions.
All right, moving on. Tax loss harvesting basics. Okay, we broke it down, how it's done. Now, what is the tax loss harvesting? What are we actually doing when we're tax loss harvesting as a tactic to try to save money in taxes?
First, I think that we need to make sure, you mentioned it a little bit earlier, but we need to make sure that people understand that this is just your taxable account. Mm-hmm. This doesn't apply to your high yield savings. It also doesn't apply to your retirement accounts because those are treated by the IRS differently for their taxes. So this only applies to your taxable brokerage account. Can I back up just a little bit? Because I wanted to clarify one other thing that I think for some reason it's a mental hurdle. At least I don't know, Rob, maybe you're the same way and maybe not. I don't know. But
no, I'm a genius. I got it all. So good. No, but go ahead.
Okay, good. So I think that people might have a difficult time getting over the hurdle of the fact that they're not taxed on everything that comes out of their taxable brokerage.
Good point. Yeah. Go with this.
We talk about the basis, but understanding that your basis is not going to get taxed. It's just the difference between what your basis is and what it is when you sell. Like what the price is when you sell. So that gets you your gain or loss. But I think when people think, I'm going to sell $20,000 worth of my stock XYZ, so I'm going to get taxed on $20,000. No, you're not going to get taxed on $20,000. You're going to get taxed on whatever the price is at the time the difference of whatever the price is between what it is when you sell and what you paid for the thing. So let's dig back into.
I appreciate that. That's a very common misconception. I've explained that. I explained that a lot. So I thank you for bringing that in. Yeah.
So this only applies to your taxable brokerage accounts that are subject to these short and long-term capital gains. You can use this as a strategy to sell high and buy low by offsetting your gains of selling high with some of your loser losses. So I actually kind of use this strategy to unwind people's taxable brokerage accounts, right? If they come to me and they have a bunch of individual stocks and they're not well diversified, and you can't just sell the lot and be done with it. Like that'd be a huge taxable event potentially. So we use this as a strategy to slowly unwind and diversify a taxable account in some occasions. So this is a way to do this. However, there are some rules and limitations to how we do this.
Well, let's talk about it. Let's talk about first before that, but we get to the wash sale, because I don't know if we've
I didn't say wash sale. What's a wash sale?
Before we get to the yet unknown rules and limitations you have planned to speak about. Now, I don't think we've really talked about, we talked about how it works when you sell, but I don't think we've talked about tax loss as a tactic yet.
That's fair.
Right? So what we're talking about and what Omen just said, that's one tactic. But at its heart, what you're doing is intentionally selling stocks at a loss. So let's say there's a down year in the market and you've got some stock ABC and it's down, and you're like, oh, I'll wait for it to come back, and over long term it'll pay off, yada yada. Well, you have an opportunity, if it's in a brokerage account, to go ahead and sell it at whatever loss it is, and then take the tax break on that loss, or offset gains if you had gains you're reporting. It's a tax benefit. The idea is you sell it at a loss, and then you buy some other investment with some limitations, which you're about to talk about. But you buy some other investment at the same time. So you sell $10,000, let's say at a $5,000 loss. You harvest that loss on your taxes and you're able to take a deduction or offset gains, but immediately you take the $10,000 and you invest in something else.
No, that's fair.
Yeah.
I think also too, we should mention that if you don't offset, let's say you've got $10,000 in losses for the year, but you only need to offset $3,000 in gains. That leaves you with a $7,000 available loss that you can actually carry forward, right? So you can, every year, outside of your offset of gains, you can take an additional $3,000 loss on your tax return.
This is big.
And then, so let's just take this example and let's bring this out, right? So $10,000 loss, and you've got $3,000 of gains. Now you offset that gain of $3,000. You can take an additional $3,000 of loss on your tax return. That leaves you with $4,000 of losses that you can now carry forward into a future year. If you do this, and you can do this indefinitely, so if you do a huge loss, you can just keep taking this tax deduction forward, $3,000 a year. Depending on how big your loss is, that might take you a while to actually get through it, but it's never going to expire.
You left out one important word in that. You're 100% right. That's all correct. You left out one important word. You first offset the gain, and then you get an additional $3,000 of loss against your income.
Yes.
Right.
Yes.
So let's say if you're in like the high tax bracket, 32% tax bracket, if you can take an additional $3,000 of loss, so long as you've got it left over after the finals that we talked about before, you have additional loss. It can go against $3,000 of income. It's super powerful. And then you can carry that forward indefinitely into the future, $3,000 a year as it stands now.
why there's two of us on this podcast, so we can back each other up in
right.
public speaking 101 when you leave something off.
Yeah. Okay. So, but there's some basics. Get into the rules that we talked about. There are some limitations, rules, and best practices, etc. That you have to abide by. You can't just do this willy-nilly.
All right. So you already ruined the surprise with the wash sale rule. The wash sale rule states, this is an IRS statement, that you cannot repurchase, quote unquote, substantially identical securities within 30 days before or after a sale. Which means if you sell, stock XYZ for a loss, and then you think, well, I'll just turn around and pour that money back in, that same money back in, and increase my buying power basically at that point. IRS says, nope, you have to wait 30 days.
If you're buying the same stock.
If you're buying the same stock.
You can reinvest it. If you got that 10,000, you can invest it in something else right away. Within 15 minutes if you want. But you can't buy it, like you said, the word is substantially identical. Identical also qualifies as substantially identical. So you can't buy the same stock. That there's other limitations too.
Yeah. I mean, so we mentioned stock XYZ. It gets a little bit complicated, but there are some things that are pretty crystal clear. This is not an endorsement to buy or sell anything that I'm about to just say here. But let's say you sell Coke, you can turn around and buy Pepsi. That is a substantially different stock. It's two different companies. Yes, they sell very similar drinks, but it is a different company all in all. So you can turn around and do that if you want. Same thing with like Apple and Microsoft or Apple and Google or something like that. If they sell the competing products, that doesn't matter. It just has to be a different company. So that is where it's, clearly identical. Just stay away from that, but you can buy different companies.
Yep. So when it gets into a little bit more murky is when we're talking about mutual funds and ETFs. So obviously grouped of investments that are cobbled together to create one product that's intended to track a certain investment like S&P 500 or, small cap value or whatever. Now this is a little more murky, right? But let's go ahead and state what's the speed limit? Like what are we technically allowed to do? The term substantially identical means, let's say the easiest example, like an S&P 500 index fund. So if you sell an S&P 500 index fund at a loss and you go and buy, of course you can't buy the same exact investment, but let's say you went to a competitor, another custodian that provides another S&P 500 index fund and purchased that one. That does technically violate the law or the statute of likely identical because those are the exact same index funds. Now, if there is some small difference where one's market weighted, and the other one is somehow weighted a little bit differently with their index fund, which is uncommon, then maybe you can get away with it. In general practice, and I even hesitate to say this, I think a lot of people just do this and it's like 5 miles over the speed limit. Like maybe it's not enforced as much because I think it's just kind of seen as a general practice that people do. I don't know. What are your thoughts on that?
Yeah, I do watch out for this. In fact, I was just on a webinar a couple of days ago with Jeff Levine, who is a CPA for Kitsis.com. And his thoughts on this are to generally stay away from this. Like, do not buy an index fund that tracks the S&P 500 from one custodian, sell it, and then turn around and buy another index fund that also tracks an S&P 500 company from a different custodian. It's just too murky. Basically, what you're doing is risking the chance that the IRS says, you know what? No, that is substantially identical. That is a wash sale. And now that you add that basis back in.
Yeah, because if hand to God, like if you had to say in your heart, you these are identical. They're going to behave exactly the same. The worst case scenario is the IRS comes in. I mean, I don't know how much of a hand slap or against, but as a practitioner, especially as CPA, of course, it opens you up some difficult liability issues. So I can appreciate the safety side of his perspective. I guess that's why disclaimers exist on our podcast. That we're like,
yes,
this is not
absolutely
specific tax advice or investment advice. Okay, so there's some wrinkles to this that are really interesting. One I was aware of, the other one I didn't know. So I'll speak to the one that I did know. This applies to you and your spouse. So let's say the IRS sees you, as one unit. So let's say you sell an S&P index fund at a loss, and the same day you tell your spouse to buy that same one on the same day, that's disallowed. The sale, the wash, the loss harvesting would be disallowed by the IRS. That's a violation of the wash sale rule.
Right. Yeah. So definitely coordinate with your spouse, because that could be completely inadvertent. I mean, the coincidence that happens, I don't know. But maybe both of you guys are investors and you're not talking to each other, and one of you sells and one of you buys.
Yeah.
It could happen. Yeah. So make sure you coordinate your investments when you're doing this. The other one is pretty interesting, and I haven't known this for very long, but it applies to your IRA as well. So if you sell at a loss something out of your taxable account, let's go back to our Coke Pepsi example here. So if you sell your Coke out of your taxable account and then think, you know what, I'm going to go buy Coke in my IRA. Yeah, disallowed.
I was today years old when I learned this. I don't remember this in the CFP at all. It probably was there. Maybe it's one of those things in one of the tabs that I've forgotten. But because it doesn't make any sense. I don't know why. First of all, someone would try to do this the taxable treatment on these things is so different. And also, I don't know why the IRS would care if you did this, because you're trading off a tax advantaged ish a brokerage account, asset for, let's say, in your traditional IRA, something that's going to be taxed at your full rate when you sell it in the future, when you cash out. So that's an interesting one. I did not know that, honestly, until we put this episode together.
Yeah, I think this is actually just more of an inadvertent probably purchase, where somebody says, you know what, I sell this thing out of my taxable, but I think it still looks good, so I'm going to buy it in my IRA. Like inadvertently, they just weren't even aware of wash sale rules in general, and so this is what they did. But I'm telling you, this is not going to go well for you.
Yeah. I guess this brings, one more idea too, because you mentioned Coke. Let's stick with that. Interesting thing, like if you sell Coke, you are allowed to buy the S&P 500, which Coke is a member of.
Oh, yeah.
Yeah. So just FYI, I mean, even though Coke is included in the S&P 500 index fund, those are not substantially identical investments.
Yeah, absolutely.
All right. So what happens if we do violate?
Good cleanup there.
What happens if we do this and it gets disallowed? What are we talking about?
Right. So it's not all bad, right? It's just not going to accomplish the thing that you thought it was going to accomplish in the year that you are trying to harvest losses. So the disallowance actually gets tacked on as your basis. So what happens, let's say you sell a stock for $1,000 loss, and then you buy something substantially identical back within 30 days. The IRS says you can't do that. So instead of taking that loss on your tax return, it's actually added to the cost basis of the new shares that you just purchased, which means that actually for a moment, potentially, it's actually pretty likely that your cost basis is going to be more than the stock you just purchased, right? It's at least expecting that that stock is going up in price. Your basis is actually going to be more. So you're going to take that loss into your next purchase of stocks.
Yeah, it's basically a hand slap. Like you get caught and they're just going to correct the mistake, and you get a little bit of, get kind of punished. But unless you're doing this maliciously and trying to hide and making up cost basis and all this other stuff, then I don't know. I don't see handcuffs in your future.
Oh, no handcuffs and no fines either, right? You're just going to end up taking that loss further on down the road. So whenever you decide to sell that investment again, that is when, assuming that you don't violate the wash sale rules again, that is when you would actually take the loss.
Okay. So we've been playing around the details a little bit here. Let's stand up here in the foxhole and take a bigger picture. I think if we've done our job, hopefully we've captured what the essence of tax loss harvesting and how it works. When does this make sense? When would we do this?
So I look for market downturns or loss heavy years, right? So if we kind of think back to 2008, right? That'd be a great time to start looking at losses. Same thing with 2020, March of 2020 would have been a great time to look at market losses. We had some turbulent times, I think, at the beginning of the year with tariffs, and we weren't sure what the tariffs were going to do, and the market reacted, particularly when deadlines were starting to come up. That was also a good time to look at losses. I don't know. What else do you think, Ron?
Yeah, I think the only thing I would say here, anytime the market's down and then if you have really high income and you're at high tax rates and you can potentially take advantage of that extra $3,000, those are good years to do it. The only thing I'll say is just do your best to avoid using short-term losses to offset long-term gains. A lot of the times the long-term gains are worth paying the taxes on because, which we're going to get to on tax gain harvesting, but sometimes it's worth just go ahead and paying the 15% for most folks or even lower, which we'll again talk to. Sometimes it's worth paying those taxes. So if you have short-term losses and you can thread the needle and get it to the next year, go ahead and pay the gain, your long-term gains, and then use short-term losses to offset income or short-term gains. Then that's going to be a better tax arbitrage on loss and gain.
I did mention it earlier when I mentioned that I use this as a strategy also to unwind single stock taxable accounts and try to get into something a little bit more diversified. Mm-hmm.
Yeah, that's a really good point. That's kind of more complicated. So please, reach out. If you have questions on how to do that, it's a little bit, you have to be a little bit more careful. But yeah, it's definitely something you can use. All right, that's a lot. Let's talk about one more tax fact, and then we'll get into tax gain harvesting. Rest assured, tax gain harvesting is a little bit more simple and straightforward. You're getting close. You're almost all the way through the second episode of Tax Planning Extravaganza. So here, the tax fact. This is the last one. This is the best one. I had a smile on my face when I put this in here, and I think Omen's already blushing.
Boy.
I can't see the blush under the beard, but yeah, I was really looking forward to reading this one to you. All right, tax fact number 3. A stripper deducts breast implants and wins. The story goes, in one of the most famous U.S. tax cases, an exotic dancer known as Chesty Love. I love it. I promised I wouldn't cry. An exotic dancer known as Chesty Love successfully deducted the cost of her breast implants as a business expense. The court agreed they were, quote, stage... I can't get through this.
You got to get through this.
I wrote it. I put this in. Okay, all right. Quote, stage props essential to her act, close quote. This case is still cited in tax law discussions about what qualifies as an ordinary and necessary business expense. So, Omen, I need to get your feedback. So how necessary is this business expense for Chesty?
I have to say that I need to come up with an email address just for you, Rob. Like, don't send your emails to me. Send your emails to Rob.
No, send them all to Omen, and I'm going to get a bag of popcorn and listen to him read these emails to me over the phone. I can't wait. You're welcome.
Moving on.
Please, moving on. All right, tax gain harvesting. We talked about how tax loss harvesting can be used to lower your tax burden, but there is such thing as tax gain harvesting, which is kind of a tactic we use to choose when we want to pay taxes in a more advantageous year. So don't think about it too hard. It's the exact opposite of tax loss harvesting. Instead of doing targeted sales of an asset, of a stock to capture the loss with tax gain harvesting, you're selling appreciated asset in order to harvest the gain and go ahead and pay the taxes in that year. When would we do this? When would we decide, say, I'm going to go ahead and pay the taxes on this?
Lieutenants, I'm talking to you right now.
Yeah.
Like specifically.
Yeah.
So again, on that same webinar with Jeff Levine, he said this in a way I've never heard before, but I thought it was absolutely brilliant. And that is, this is the one time in life you can maybe plan for a free step up in basis, right? When do you normally get a step up in basis? It's when somebody passes away and you inherit their asset. You inherit a home, you inherit an investment, and now all of a sudden your basis is what it was on the day of their death, the value on the day of their death. But here, particularly if you were in the 0% long-term capital gains tax bracket, you can sell your asset as long as you stay in that 0% tax bracket, sell it. And there is no wash sale rule here. You can turn around and buy the same investment 30 seconds later, and now you have a step up in basis, having not paid taxes on the gains.
Yeah, that's a good clarification. There's no wash sale rule. That's perfect. Yeah, because you could do this. You just basically get a free step up in basis that you wouldn't have to pay taxes on in the future. The key to that is, like you said, and you're making the joke about the lieutenants, is that lower income year. This applies to combat. If you're in combat zones, it's a perfect year to do it when your income is really low on paper. You got a lot of those exclusions that we talked about in the last episode. You have a lower income, therefore you're in that 0% long-term capital gains bracket. it even might make sense every once in a while, maybe in the 15% as well. Like you're just, if you want to like get that tax benefit, you want to fill up that tax bracket that we sometimes we talk about, might benefit you as well. But yeah, that's the most common is when you're lower income years to get that free step up to higher cost basis.
Yes.
Yeah. That's pretty much the long and short of it for a tax gain harvest. It's that simple. So just make sure, again, you're using your taxable brokerage account to do this. Make sure you look at your tax picture. Tax planning helps. And then just, reach out to a professional to take a look at your situation. Like, hey, am I crazy? It seems like I'm going to have lower income. This might be a good strategy for me. Or with loss harvesting, this might be a good year to do that. Reach out to a pro, ask them what they think. If you have a tax preparer, a professional, like a CPA, a lot of times they'll take a cursory look for you and help you out. And of course, Omen and I are here to help. So, all right. So we want to do this. What do we do? Do we just go in and trigger these trades and that's it? Or how do we go about doing a tax loss or a tax gain?
Right. So a couple of tools at your disposal. First and foremost are your own investment statements. So make sure you're keeping those investment statements. Don't just let them flow through your email right into your trash like most people do. Like you actually want to hold on to those investment statements so you understand what your gains and losses actually are.
Yeah, track your transactions in those statements too to make sure you're tracking them as well. Most custodians are real good about it. They'll track your cost basis for you. The one that I use, I know you use with clients, it does a really good job with that. But yeah, just track your positions, make sure you know what your cost basis is so you can identify when something like this is open to you as a possibility. The next step is to then identify whatever positions you have, whatever stocks you have that you could possibly sell at a gain or a loss. This might involve a little bit more. You might have to dig in and find out, because you might have, if you bought QQQ 10 different times, well, you have 10 different groups of basis based on the price of that stock when you bought it. So when you go in to sell at a gain or a loss, you actually have to find whichever lot of stocks it is that you want to sell at a gain or a loss. So don't despair, because don't just hit the sell button. Go ahead and call your custodian, go and call Vanguard, whoever you have, and tell them, I want to sell these specific shares. Otherwise, they're just either going to do, the FIFO method where they're just going to sell the first ones you have, and it might not achieve the tax benefit you're looking for. So you have to work with them and tell them, these are the exact shares I'm about to sell.
Yeah. So number one, this is not a recommendation to buy a QQQ.
Yeah.
Number two is, you're welcome. Yeah. Number two is, you've mentioned lots before, but I want to make sure we clarify here for our audience that a lot is simply the group of investments that you buy at a single given time. Mm-hmm. And so just like Rob said, when you buy something 10 times over, you're going to have a different lot number for each one of those so that you can then go back in and specify, I want to sell lot 1, 2, 3, 4, 5, 6, and sell that very specific thing to get the tax advantage that you want for that specific investment. So I just want to clarify the word lot number, because I think we mentioned that a little bit earlier in the episode, and I just want to clarify that for people.
Good clarification. And finally, we're near the end, guys. Well done. Last thing, just a reminder, again, please avoid the wash sale rule with timing of your investments or the investments you choose to reinvest in. So just one more hammer on that point. I think we did it. That's it. I feel much better getting through this one than I did the last one we got through. I felt like I would just have my head buried in a calculator the entire time. This one felt a lot better.
It was long.
Yeah. I think Chesty Love was what got me through.
Bro,
she's the mascot of the Fiscal Foxhole.
Trivia. Let's go.
Great transition. All right. Now is the time of the show. In the Fiscal Foxhole, we move on to our trivia challenge. This is the weekly challenge that up until last week, we were tied 0-0, which I took great pride in up until that moment. And now I'm left devastated, as at the worst end of a 1-0 balance. Omen has scored a point in the last week. So the score is 1-0 in Omen's favor. So now I stand at the crossroads of trying to decide, do I try to match and beat him, or do I sit and wallow in 0 and try to maintain a 0 balance till the end of the year? We'll see.
I don't think it's going to be that difficult. The fact that you listen to your podcast at 1.0 speed indicates the number of intelligence that I think you actually have. So anyway, let's ask the question. In the late 1990s, some hedge funds tried to supercharge tax loss harvesting using something far beyond ordinary stock trades. What wild strategy did they use that later got shut down by the IRS? Was it A, they sold artwork and immediately repurchased near identical replicas to claim their losses? B, they created digital twin corporations offshore to mirror losses? C, they used complex basis shifting partnerships, buying and selling the same assets through multiple shell entities to multiply losses on paper? Or D, they intentionally crashed their own tech stocks before mergers to reset cost basis?
Well, I thought this was going to be complicated. Jeez. God, like I caught the first one, and after that, all I heard was business and legal. Yeah. Okay. Boy. So, I mean, they all sound possible, especially when they're creating digital corporations or shell corporations. What was the last one?
They intentionally crashed their own tech stocks before mergers to reset cost basis.
That one sounds like the most likely, but because they're able to, I don't know how much they're able to influence those investments. So the artwork intrigues me because hedge funds, they can invest in all kinds of different types of assets, but the last one sounds like the most probable, even though, because I imagine C with the shell companies, they probably still do that all the time. Maybe. All right, let's go with D. Let's go with D and see how that works out.
Your answer D is incorrect.
Good.
Just doing my best to keep you at 0.
I don't want to win. I don't want a point. I want 0. All right, which one was it?
The answer is actually C.
And you did me wrong with C. Okay. Yeah.
It refers to the quote unquote son of a boss tax shelter, notoriously early 2000s scheme where wealthy investors used partnership basis shifting to generate artificial paper losses. The IRS ultimately shut it down, calling it one of the most abusive tax shelters in history.
Yep. Makes sense. Yeah. Like I said, that one seemed like the most likely, but the only thing that steered me away from that is the fact that I wondered if the IRS would catch on or enforce it. But hey, that's good. I'm glad that the IRS is cracking down on stuff like that. So, okay, well, that's good news. And the other good news, you know what? I like my 0. I'm going to keep it. Hopefully I'm going to carry it through. My goal now that I was like, well, if I take a point, then okay, I'll engage in the contest. But now I'm on 0. I'm holding on to 0 to the end of the year.
You hold your 0.
All right, well, I'm going to take my 0 and go home because that's going to wrap it up for today's episode of the Fiscal Foxhole. We hope you took something away that you can use in your life. We appreciate you hanging out with us in the financial trenches. If you like our show, we'd love it if you wrote a review or better yet, shared it with a friend. So, Omen, what are our takeaways from today?
Our key takeaway number 1, the car you drive can seriously impact your insurance bill. Some makes and models are riskier and pricier to insure. So be sure before you buy, check how that dream car scores with insurers. And remember, cutting coverage to save a few $100 can backfire fast. Takeaway number 2, if you sell an investment for less than you paid, that loss can offset your other gains and even up to $3,000 of regular income each year. It's a smart way to make a down year work in your favor when tax time rolls around. Takeaway number 3, you can't buy the same or substantially identical investment within 30 days or the IRS cancels your loss. That's the wash sale rule. Keep track of what you sell, when you sell it, and what you buy next so your tax break doesn't disappear.
We'd love to hear from you. If you have questions you'd like answered on the show, please send us a note to fiscalfoxhole@gmail.com. If you heard something today that you'd like to discuss further, or you just want to dig deeper into your own financial game plan, both Rob and Omen are accepting new clients and always happy to chat. You'll find the links to their websites or to book appointments in the show notes. Rob Moore and Omen Quellvog are both registered investment advisor representatives. This podcast is for educational and entertainment purposes only. While they are both advisors, they are not your advisors. Therefore, nothing you hear on Fiscal Foxhole should be taken as specific investment, legal, or tax advice. For guidance tailored to your situation, please consult a qualified professional who understands your individual circumstances.
So, Rob, as we move into our off-duty section here, I sent you a picture, but I have to tell you about this in person now that we're talking to each other here.
Oh, you're talking about the
sausage,
the barbecue,
the sausage fatty. Yeah,
I've heard about this. I've never seen it. Yeah, what is that?
So I only break this thing out really it's only twice a year at this moment, because otherwise it's a coronary issue.
Yeah.
So, like I said, scrambled eggs with diced onions, jalapenos, bell peppers, and you can really put anything you want in there, really. And then some shredded cheddar. Then you wrap all of that with like Dean's breakfast sausage. And I use the hot sausage. And then you wrap that with weaved bacon.
Oh, God.
And then that sat in my smoker this morning for 2.5 hours. And that is going on a camping trip with me this weekend.
That's unbelievable. That sounds, I've never seen that before. I've heard sausage fatty, and I never really understood exactly the concept. You sent that picture. I was like, oh, what is this? And looked it up. Yeah, that sounds unbelievable.
It's good.
Yeah. What are the other things?
Yeah, it's really good.
Is it usually a breakfast thing?
What do you mean?
Well, I mean, I guess at the risk of going into other what else can you put in there? Like, what else do people normally stuff it with?
Oh, in a sausage fatty?
Yeah.
Whatever.
More sausage.
Whatever you want to wrap in bacon.
Yeah,
so, which is pretty much anything, right?
Yeah.
So I'll also mention while we're in this off-duty section that the time that we chose this podcast was also the same time that my phone, like both my phones, have been blowing up. Oh. The MFA Slack channel has been blowing up. Like, what is happening right now? Is the world ending in this 1 hour time while we're podcasting?
I have no idea. Well, let me check, because I don't know. Well, my MFA Slack notifications haven't been, so maybe it's direct messages. Maybe did you forget to pay your dues?
Maybe. maybe they're kicking me out.
Yeah.
Busting knees or something.
Well, that's interesting. I've never done that. I do have a smoker, and we've done ribs and pork shoulders or whatever. It's funny. I think it's odd. As much as I love barbecue and stuff like that, my family, sometimes if stuff has too much smoke flavor on it, I'm the only one that cares for it in my family. Like, they're not.
Interesting.
I know. I do a pork shoulder. It tastes unbelievable. Or grilled chicken wings at a lower temp in the smoker, smoking them. They're like, oh, we like it just straight up grilled. So the family and smoked meats, they're kind of take it or leave it. So I do it every once in a while, but man, I sure enjoy it. But that sounds unbelievable. I'm gonna have to give that a try.
Are you a pellet smoker, charcoal, wood? What do you got?
I got a pit barrel. Have you ever heard of that? Yeah. So it's just, It's basically a large, 55-gallon type drum that's repurposed as a smoker. It's technically called a cooker because if you do it, I guess how it's designed, the temperature gets a little higher than typical smoking ranges. But what I do that, the charcoal ring. So I make that at the bottom. So instead of having a full bed of coals going that's kind of, starved for air to keep it low, I actually have a charcoal ring going. It lasts longer, and I kind of temper the air a little bit so that it'll last quite a bit. So we're just trying to get the smoke on it. It doesn't always cook well with that. But the nice thing is if it gets like all the way around the smoke ring or the charcoal ring, it's smoked well, then I can actually put more coals on and it'll cook at a higher temperature.
Oh, okay.
Yeah. It works really well.
Yeah.
Yeah.
I've got the Weber Smoky Mountain charcoal, and I had considered going to pellets mainly because I was tired of being chained to the smoker for 11 hours a day. Mm-hmm. I found something a couple of years ago that changed my life. And we're sitting here endorsing products that aren't sponsoring the show. Maybe they should be, but the ThermoWorks brand.
Oh, is that where like it opens the airflow automatically?
Yeah.
Oh yeah.
So like you put an ambient air thermometer up on the top grate, and on the bottom, it's a fan, a USB fan back to the control device. You close off all the other air vents, and the fan just blows to get it up to the temperature, and then the fan cuts off. And it's Bluetooth. It sits on my Wi-Fi, so I can actually go to Lowe's or to Home Depot to pick up all my home maintenance things that we talked about earlier.
Yeah.
While I'm smoking, and it works like a charm. It is so. It was a life changer.
That's cool. I think they have one similar for the pit barrel, something like that. But I've resisted buying the accessories because I really, at some point, want one of those large ceramic cooker, like grill. Yeah, I really want one of those. And Those have a lot of different accessories you can buy. So it's like, I'm just saving up. So at some point I can buy the Kamado Joe or the green egg or whatever it is. I almost pulled the trigger a couple of years ago, but it's like one of those things when, especially a financial planner, we had that mindset where it's like, I've got stuff that works just fine. Why would I replace it with something else? But eventually, if I leave it out in the rain for enough years, it'll rust out and I'll be able to get what I want.
Your excuse.
Yeah.
Yeah. Well, as we wrap this up, last thing is going to be the turkey. I always smoke the turkey. It's poultry, so like it doesn't really pick up a smoke flavor, but it sure does save space in the oven. And figured out a way to still make a turkey moist while sitting. Have you ever done like a beer can chicken?
Yeah. Mm-hmm.
Yeah. So like almost identical. Doing it that way with a turkey just to keep it from drying out. Seems to work out pretty well.
And it's fun to say spatchcock. Is that what you're going to do? Spatchcock?
No.
Oh, no. You even know what that is?
Yes.
Oh, okay.
Where you flay it out, right?
Yep. Correct. Mm-hmm.
Yeah.
Well, good luck with that.
All right. Our key takeaways. Number 1, the car you drive can seriously, I don't like that. Oh, I started that. That loss can offset your other. Takeaway number 2, if you sell an investment it's a smart way to make a down year work. Why is this such a tongue twister, man? Golly. Stop it. Takeaway number 2, if you sell an investment for less than I know this is going on the outtakes. Oh my gosh. And takeaway number 3, you can't buy the same Takeaway number 3, you can't buy the same. Stop it. I set myself up for failure with this.